The stock market might seem like a complicated world, full of numbers and jargon, but it doesn't have to be. Be it you're new to investing or just need a refresher, this video will break down the basics of the stock market in simple, easy-to-understand language. From index funds versus mutual funds to understanding key indices like the S&P 500, the Russell 1000, the DAX, and the NASDAQ, we've got you covered. In the stock market, the fundamental principle driving price changes is the concept of supply and demand. This is similar to any other market, whether you're buying goods at a store or negotiating a price for a service. The basic idea is that the price of a stock rises and falls based on the balance between how many people want to buy the stock and how many people are looking to sell it. When more people want to buy a stock than there are shares available for sale, demand outstrips supply, and this tends to push the price up. Think of it like a popular concert ticket. If everyone wants to go, but only a limited number of tickets are available, the price of those tickets will rise because more people are trying to buy them than there are tickets to sell. In the stock market, this increased demand comes from buyers who think the stock will increase in value over time or that it is a good investment. When they bid higher prices to secure shares, the stock price naturally rises. On the other hand, when more people want to sell a stock than there are buyers willing to purchase it, supply exceeds demand, and the price tends to fall. For instance, if news breaks about a company's financial trouble, or if investors lose confidence in its future growth, a large number of people may rush to sell their shares. However, if not enough buyers are willing to purchase the stock at the current price, sellers will start lowering their asking prices to attract buyers. This excess of shares available for sale, combined with fewer buyers, causes the price to drop. The stock price is determined by the price at which the most recent transaction occurs. If many people are bidding higher, the price goes up. If more people are selling, the price goes down. This dynamic of buying and selling, driven by people's perceptions, expectations, and reactions to both company-specific news and broader market trends, creates constant fluctuations in stock prices. Investing in the stock market offers one of the best opportunities for long-term growth. Over time, stocks have historically outpaced other types of investments, such as bonds or savings accounts, in terms of returns. While stock prices can fluctuate in the short term, the overall trend has been upward. If you look at the long-term performance of major indices like the S&P 500, the average annual return has been around 7 to 10% after inflation over several decades. One of the key reasons stocks tend to perform well over time is because they represent ownership in companies that are growing, expanding, and becoming more profitable. As companies increase in value, so too does the stock's value. This growth can be driven by factors like innovation, market expansion, and efficient management, all of which contribute to rising stock prices. Compared to other investments like bonds, which offer fixed returns, or real estate, which can require significant time and capital to yield returns, stocks provide a more accessible and liquid option for individuals looking to grow their wealth. Bonds, for example, tend to offer lower returns because they carry less risk. While stocks are more volatile and carry higher short-term risk, the potential for long-term gains far outweighs those risks if you remain invested over many years. Index funds. These are funds that aim to match the performance of a specific market index, like the S&P 500. They're usually passively managed, meaning there's no active buying and selling of stocks by a manager. Benefits include lower fees and a simple, hands-off approach to investing. Mutual funds. These are actively managed funds, where a professional manager makes decisions about which stocks to buy and sell. They can offer higher potential returns, but usually come with higher fees. When deciding between index funds and mutual funds, the key difference lies in how they are managed and their cost structure. Index funds are passively managed, meaning they track a specific market index, like the S&P 500, and aim to mirror its performance. Because of this passive approach, index funds typically have lower fees and are often considered a more cost-effective option for long-term investors. On the other hand, mutual funds are actively managed by professional fund managers who make decisions about which stocks or bonds to buy and sell in an attempt to outperform the market. While this offers the potential for higher returns, it also comes with higher fees and the risk that the manager may not beat the market. For investors looking for a low-cost, hands-off investment that tracks the broader market, index funds are a strong choice. However, if you prefer the potential for professional management and are willing to pay higher fees for the possibility of outperforming the market, mutual funds might be more appealing. Ultimately, it depends on your investment goals, risk tolerance, and whether you're comfortable with the extra cost for active management. Stock market indices are essential tools that track the performance of a specific group of stocks, giving investors a snapshot of how the market or a particular sector is doing. One of the most well-known indices is the S&P 500, which tracks the performance of 500 of the largest publicly traded companies in the U.S. It's often used as a benchmark for the overall health of the U.S. stock market, representing a broad cross-section of industries. Another key index is the Russell 1000, which includes the 1,000 largest companies in the U.S. It's often compared to the S&P 500 because it also covers large-cap stocks, but includes a broader range of companies, offering a slightly different perspective on market performance. The NASDAQ Composite is another popular index, known for its heavy concentration of technology stocks. It's home to many of the largest tech companies in the world, so it tends to be more volatile and is often seen as a barometer for the tech sector's performance. Lastly, the DAX is a major stock index in Germany, consisting of 30 of the largest companies listed on the Frankfurt Stock Exchange. It's often used to gauge the performance of the German economy and is the equivalent of the S&P 500, but for Germany. Each of these indices provides valuable insights into different parts of the market, whether you're interested in U.S. stocks, technology, or European markets. Understanding these indices helps investors get a sense of market trends and make more informed investment decisions. Building a balanced portfolio involves diversifying your investments across different types of assets to reduce risk. By combining investments in major indices like the S&P 500, Russell 1000, and NASDAQ, along with international indices like the DAX, you can create a more well-rounded portfolio. The S&P 500 and Russell 1000 give you exposure to large U.S. companies, while the NASDAQ focuses on the tech sector, which can offer high growth potential, but also more volatility. Adding international exposure through the DAX helps you tap into the German and European markets, which may perform differently than U.S. stocks, especially in times of global economic shifts. This mix of U.S. and international investments, along with varying sector focuses, helps to spread risk. If one part of the market underperforms, other areas may perform better, reducing your portfolio's overall vulnerability to market swings. A diversified portfolio can help smooth out returns over time, making it a key strategy for long-term investors looking to balance risk and reward. A smart way to begin is by investing in index funds. These funds offer broad exposure to the market and are passively managed, which means they have lower fees and provide steady, long-term growth potential. They're an easy, low-maintenance way to build a diversified portfolio. A useful strategy to minimize the impact of market volatility is dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you'll buy more shares when prices are low and fewer when prices are high, averaging out the cost over time. When investing, it's also important to keep an eye on fees. High fees can eat into your returns over time, so look for low-cost index funds or ETFs. Finally, to stay on track, stay informed. Regularly check the performance of your investments and keep up with market trends. You don't need to watch the market every day, but staying updated on economic news and the health of the companies in which you're invested can help you make better, more informed decisions. By following these tips, you can build a strong foundation for long-term investing success. The future of the stock market is being shaped by several key trends that are transforming how people invest and what they invest in. One of the most significant changes is the rise of technology and innovation. The increasing use of artificial intelligence and automated trading platforms is revolutionizing the way trades are executed. These technologies can analyze vast amounts of data in real time, making it easier for investors to spot opportunities and execute trades faster than ever before. As AI continues to improve, it will likely play an even larger role in investment strategies, from stock picking to risk management. Another trend to watch is globalization. More investors are looking beyond their home countries, seeking opportunities in international markets. As global markets become more interconnected, investors are increasingly investing in international indices and companies. This trend is expected to continue as emerging markets grow and global investment platforms make it easier for individuals to access global assets. Finally, there's a growing focus on sustainable investing. Investors are not just looking for financial returns, but also want to align their portfolios with their values. This has led to a rise in ESG, environmental, social, and governance investing, where companies are evaluated based on their impact on the environment, society, and governance practices. As more people seek to invest in ways that reflect their personal beliefs, sustainable investing is likely to become an even more significant part of the stock market landscape.
If you found this video helpful, be sure to hit the like button and subscribe to the channel. Until next time, this has been The Long and Short.